Hi, this is Francesco Nagari, Deloitte Global IFRS Insurance Leader. Welcome to our April 2019 IFRS 17 webcast. Today's webcast is titled The IASB Signs Off Its Proposed Amendments to IFRS 17, and is a webcast that will also describe to you what happened in potentially the last of the meetings of the IFRS 17 TRG. The agenda for the webcast is structured as usual on 3 points. First, I'm going to give you the highlights of both the TRG meeting that was held on the 4th of April and the IASB meeting which was held the following week on the 9th of April. We spend most of the time during the webcast discussing in more detail the discussions and the decisions that the IASB reached and the consensus or lack of consensus that may have been detected through the discussion at the TRG. And then I'll spend a couple of minutes at the end to give you my perspective on what could be the next steps after the board meeting last time. Let's begin with the TRG highlights. The first one is the fact that there was a relatively short, in fact the shortest TRG meeting out of the series so far. This is the fourth one, and the first 3 meetings were all at least a day long. This one was only half a day. The reason for that was that there was just one paper that was discussed specifically during the meeting. That is a paper on investment component within an insurance contract. The debate highlighted a number of areas where TRG members had different views on how the investment component should be accounted for, and there's going to be some consequences as a result of that discussion with the amendments going to be published later on. The meeting was short because, to my personal surprise, the IASB decided that out of the 46 submissions that they received since the September TRG meeting, 43 of them were rejected, and rejection means that they were not developed into standalone papers out of the relevant submissions for discussion at TRG. And the reasons could be one or three. We'll see a selection of those. There is clearly quite a lot more than you can talk in the space that I would normally allow for a webcast. But I picked some of the most material ones, in my opinion, and hopefully this selection will be still informative for you. And the criteria are: one, the standard is clear enough, and so there is no merit for discussion. Two, you have effectively asked a submission that is too specific to a transaction, and the TRG will not develop implementation. And three, there is already another process other than TRG that is ongoing, which may address the submission concern. And the key process that the IASB has been referring to is the fact that they are working on the amendment to IFRS 17 that is going to be published. There are consequences still, despite not being debated individually. There's been a lot of discussion around these submissions that were rejected, and in fact there were some consequences that will in fact feature into the exposure draft, and I'll tell you more about that. On the 9th of April, the Tuesday of the following week, the IASB considered the whole picture of the amendments produced to date, and they have decided to approve them unanimously and to effectively move forward as of the 10th of April with the balloting process, which means that now the official drafting period has begun. The draft will be circulated privately to the board members who will then comment back, and at one point we'll have the opportunity to vote for publication of the standard, proposed standard amendments. The staff concluded that none of the amendments that were tentatively decided to date would unduly disrupt the implementation, or there could be disruption that would be justified beyond what the stakeholder fed back to the board. Also, the cost and benefit analysis, and we see that point by point, confirmed that in all cases it was justified to proceed on that basis. And so the unanimity of the consensus around that is probably the most important piece of news to report back on that. On top of this strategic decision, the IASB also worked on 5 SWIP issues and 7 amendments to be included in the exposure draft in the package that they call the annual improvements amendments of IFRS 17. And also, subsequently to the board, the technical plan has been updated, and now we know that the target date has been refined to be June 2019. So these are the highlights. Let's now move into the TRG detailed discussion on the investment components. The paper was debated quite lively by the TRG members. It was divided in three parts. The first part was around determining whether insurance contracts does or does not have an investment component. So this is an area where I and the other TRG members had a fairly good exchange of views with the staff and the board members. The board members actually were quite vocal during the TRG discussion and indicated that they felt that the three submissions that were considered as the basis for the paper indicated that there was a need to amend the definition to make it more clearly understandable to the preparers of financial statements as to what the intention of the IASB was. And so what they are proposing, and in fact it's most likely going to be featuring in the exposure draft, is to add the words "in all circumstances" to the current definition of investment components, to make it clear that it's an obligation to pay cash, to repay cash to the policyholder under all circumstances. That creates the investment component. They say that the amount that is repaid to the policyholder when the insured event does not occur is not a good enough amendment to the definition, albeit it was proposed in one of the submissions, and that was rejected. This also created the longest portion of the debate around this element of the paper, because the staff and the board members explained that they have identified that there is indeed another amount that maybe that is a repayment of cash to the policyholder, and it is associated with an event that is not the insured event, and that is the refund of premium. When a policyholder cancels a policy, often the insurer repays a portion of the premium that is associated with the unexpired coverage that is no longer going to be delivered. But the IASB said that is not an investment component, because if the coverage was consumed or received up to its natural expiry point, then there would be a circumstance in which no cash payment would be made, because at that point the premium will be completely retained by the insurance company and the policyholder will get nothing. They said that's not what we meant. The investment component has to be a cash amount that goes back to the policyholder no matter what. And that's why they felt that in all circumstances was to be a better way. Comments that we heard, comments that I made on the TRG discussion around this point included, for example, does it mean in all circumstances that this has to be present all the time? The board gave us the board members gave us an indication that perhaps not. So there could be a period of time when there is no investment component, and then, for example, because you have an accumulation of premium, the investment component starts appearing at one point later. Other points that we raised as TRG members is what's the point? Isn't the premium refund being treated in the same way as an investment component? This is where actually we had a bit of a disagreement. One TRG member and I. That first TRG member was saying that this treatment is identical to the investment component, and actually demonstrated that it doesn't, because the premium refund may not be in line with the earning of the profit of the CSM or the premium allocation approach liability for remaining coverage up to the point of cancellation. Anyway, there were some consequences which are going to talk about it, and these will actually result in amendments to IFRS 17 beyond just a mere amendment to the definition that the IASB already put forward. The second part was much shorter in terms of the discussion. This is the discussion around when you have identified an investment component in the contract, then you need to determine whether or not it is a distinct investment component. If it is distinct, IFRS 17 then requires its accounting to be done in another standard, IFRS 9. What I felt was probably the most positive piece of news is confirmation of something that we at Deloitte have been saying to our clients already for a long time, and that is that the frequency of a distinct component, investment component, is probably very, very low. and that is because it's quite unlikely that you will have equivalent terms to an investor component within insurance contracts for financial products in the market. In particular, the timing of payments being dependent on the death of the policyholder is unlikely to be easily replicated, and that means that the interdependencies of the investment and the insurance component will be present, therefore prohibiting the unbundling of the investment component. So that leads us then to the third part, which again triggered another substantial amount of debate in the TRG, and that is the determination of the amount of an investment component. Given that when it is not distinct, you still have to quantify that for a number of reasons. Presentation, it has to be disaggregated from the insurance revenue and insurance service expenses. Measurement of profit as well, given that it feeds into the CSM unlocking and therefore has a direct impact on the profit emergence of insurance contracts. There was a discussion here about the various ways of measuring whether the investment component is an explicit contractual cash payment or not. What should be done? We have confirmed through the discussion that the time value of money matters in the accounting for the investment component. And also there was a debate where I actually had expressed my disagreement with some of the proposed views set out in the staff paper regarding the investment component effectively becoming a gross amount against which there could be other amounts that the policyholder would effectively buy with the money received from the investment component. I disagree that the words in IFRS 17 as it is now would lead us to the gross settlement logic, and so I believe that there is only one settlement, and that is the amount that would be repaid. There is no gross amount. If there was a gross amount, it would create substantial complexity in the determination of the other amount, and would also open structuring opportunities and arbitrage in terms of the accounting. So I believe that that message was registered by the IASB. We'll see whether this is going to have any impact on the finalization of the exposure draft or not. Moving then to the second TRG agenda, which is the rejection paper. This is where I start with my selection. The first one is submission 115. It's an important clarification. The submission requested to clarify how do you determine the substantial share of a policyholder in order to be able to determine if a contract does or does not meet the criteria to be accounted under the variable fee approach. This is the second of the three criteria, the one that goes under paragraph 101B, 101B. The staff explained that a determination based on any calculation other than a calculation of the policyholder share in the gross fair value returns on the underlying items would be inconsistent with the requirements of IFRS 17. They also produce an example where the gross return is then reduced by the application of a basis point charge for asset management. They said what the share comes to the policyholder is after deducting those amounts that are linked to the value of the underlying items. So you start with a gross amount and then you deduct what you're going to effectively not receive to establish whether the remaining share is substantial or not. Also, they noted that the third criteria, B101C, which requires the entity to expect a substantial proportion of any change in the amounts to be paid to the policyholders to vary with the change in the fair value of the underlying items. In that instance, this condition, an entity would consider the changes in any amounts to be paid to the policyholder, regardless of whether they have been paid from the underlying items or not. So the key example here was to have this asset management charge calculated by reference to basis points fees, and then a mortality charge, which was on a fixed amount basis. And what the IASB staff explained here, the standard was clear already, and therefore didn't need to be discussed, is that obviously the fixed mortality charge is not to be counted in the determination of the substantial share because it's not dependent on the fair value. So that creates clarity for sure, but also, and I said that much during the TRG meeting, creates an opportunity for structuring. Given that both charges are under the control of the issuer of the contract, a I can see that there is a possibility for the variable versus the fixed charge to be considered in order to achieve a particular accounting outcome under IFRS 17. We'll see whether this matter will continue to be debated in the leading up to the exposure draft, or whether this will be effectively a post-exposure draft publication matter that may be resolved one way or another. The next point I selected for tonight is submission 118. This is about the measurement of the risk adjustment. And the question was whether the entity that measured the risk adjustment liability should measure that liability with consideration of the insurance purchased or not. Personally, I was surprised to see that the IASB has actually said it should be whatever you decide to be the case in terms of setting your compensation. And so that means effectively a true application, almost literal application of the words, which say the entity will set the compensation and then measure the risk adjustment accordingly. So if there is entity A, which takes into account the insurance that they have purchased in setting the compensation for standing ready to suffer the consequences of that uncertainty, then the risk adjustment liability will be calculated effectively net over insurance. And when they calculate the risk adjustment assets on the insurance contract that they've purchased, that risk adjustment could be as low as nil, zero. Another entity may actually not take reinsurance into consideration when setting compensation for the same risk. And in that case, they would record a risk adjustment liability, which is much greater, but then they will book a risk adjustment asset on the insurance contracts held, which could technically produce exactly the same balance sheet and P&L as the first company. But in terms of no balance sheet, the same net asset, the same equity as the first company. But in terms of balance sheet, the two balance sheets would be very different, potentially materially different in terms of the liability and the asset reported in the balance sheet. So that's a very interesting point. There is a question raised as to how do you ensure that the risk of non-performance of the insurance company is reflected in a consistent way, given that there is no guidance to be comply with when you take effectively a portion of the insurance asset out of the assets and therefore out of the application of the relevant paragraph and you put it instead in the liability. And that's actually related to the second topic on this page, which is submission 119 and the risk of non-performance. So this is actually not the point that I made earlier, but related to the same accounting requirements. So paragraph 67 is the one that actually says you must account through P&L all the changes in the risk of non-performance that come from the insurance company. The submission was asking, should then the risk adjustment be reflective of the risk of non-performance of the insurance company that you are buying from? And the answer is no, because the risk adjustment for the insurance contracts held is actually not with relation to the asset and the counterparty. It is actually measured by reference to the relief from the liability perspective. And that's why you need to see the first one, submission 118, in light of submission 119 to understand the logic. The logic is that whether you do it already in the liability or in the asset, you still calculate the risk adjustment from a total balance sheet perspective, net of reinsurance. And therefore, once you have this asset, that asset is the relief that you're getting. Then you got the application of 67 and the impairment. The impairment comes from the cash flows. Obviously, if you are going to impair the cash flows as a result of deterioration on the risk of bankruptcy of the insurance company, the risk adjustment asset will also have to suffer the consequences of that. Obviously, that asset will not remain there untouched by the impairment decision. However, this is not the point. The point is that the risk adjustment is not inclusive of the credit risk arising from the insurance company that you buy reinsurance from. The next topic is actually a rejection that combined three submissions, 101, 120, 124, and is all, again, about the risk adjustment. The question here was how to link the presentation option in paragraph 81, whereby you can, if your technique allows it, split the changes in the risk adjustment between a component which is associated with the time value of money and the rest, and the measurement of the insurance contracts. And the question then is, would the portion that is separated because of presentation choices from the rest of the change still adjust the CSM when you unlock the CSM for changes in the risk adjustment? The standard apparently is clear. I didn't see that very clear. In fact, the standard will be amended to make it clear. But anyway, it was not discussed because they decided already to make it clear in the exposure draft. So bucket C, as you can see at the top of the slide. But the point is, it's now clear that we're going to see an exposure draft that tells us that a presentation decision will also have measurement, profit, and revenue consequences, because that portion will not adjust the CSM. So you only adjust the CSM for a smaller proportion of the changes in the risk adjustment if you make the election under paragraph 81 compared to the adjustment you will make if you don't make the election. And it is entirely your choice. So paragraph 81 does not force you to make a choice to split the changes between the ones that come from the financial variables and the ones that don't. But once you do, there are consequences which are now going to be made clear in the special draft will have an impact on measurement. And here is where I'm summarizing the feedback from the TAG meeting in terms of the amendments that were going to come. The first one is the amendments to clarify the definition of investor component. So we already talked about the fact that the board said, well, all this energy and lively debate proves that we were right. There is confusion on the interpretation of the definition, so we must do something about it. So they're going to clarify in the exposure draft along the lines that were described during the TAG meeting, and potentially even more. This indeed is a topic that may actually come back in the board discussion next month. We'll see. We'll see whether that is the case. The next one is the amendment to address the desegregation of changes in the risk adjustment for non-financial risk. As I mentioned earlier, it was a rejected topic, but no one that was clearly understandable from the standard. The staff acknowledged that this was a problem, and effectively they already had in mind, but without having the debate in TRG, sadly, the fact that they were going to make a change. And here, effectively, we're going to see that paragraph 96B, B96D of IFRS 17 will not be amended because of the changes, but they will actually make it clear now that it will be a consequence of the application of 81. So if you do that choice, if you make that choice, then B96D will be amended to say your CSM adjustment will have to be the one without the financial variables related change of the risk adjustment. And then the third feedback is on the amendment to clarify the changes in the measurement of a group of insurance contracts caused by changes in underlying items and how they should be treated. This is particularly associated with a situation where the underlying items are not items which would be reported in the financial statements of the insurer at fair value through P&L or at fair value through OCI. If you have such an underlying item, and it could be, for example, the sharing of the profit of the company or the sharing of mortality experience from the same portfolio of participating contracts. In that case, you still have to calculate the fair value in order to determine the changes in fulfillment cash flows. The question was then, would you be able to allow that change in fulfillment cash flows not to go into insurance finance income or expenses because there is nothing on the other side? And the answer is no, you will not be allowed to do that. There will be an amendment to make it clear that no matter what is the source and whether that source creates an equal and opposite fair value gain or loss in the financial statements, the fulfillment cash flows impact from the fair value of the underlying items must be classified entirely as an insurance finance income or expense amount. Then let's move now to the board. The board meeting on the 9th. So what I'm going to do here, I'm going to run you through 13 pages of quick assessments. Every page is structured in the same way. So you have at the top a quick summary of what the amendment is, and then the 4 things that the board discussed on the 9th. which are effectively the criteria to go forward with the ballot. Whether this change does or does not reduce useful information, whether there is an undue disruption of ongoing implementation work, what are the effects in financial statements, and what is the outcome of a cost-benefit analysis. The first one is the scope on equity release mortgages, which are life insurance contracts, effectively as described. They're going to be scoped out on an election basis. The assessment across the 4 boxes is positive, with particularly a benefit in terms of cost that will be effectively spared from those entities that only issues insurance contracts that have got this particular type of contract, effectively banks. The second one is similar. This is for credit cards, and you have effectively a similar conclusion in terms of the 4 points of analysis. There is no significant loss of information, no significant disruption of ongoing implementation. The effect on financial statements should be minimum, and the cost-benefit analysis is positive/neutral. So again, no problem on this one. The board then moved to number 3, which is acquisition cash flows. This is actually an important new change. It does create some accretive usefulness in the information produced in the financial statement, so that's good. But it does disrupt the implementation already in progress, because we're going to do different accounting for these acquisition costs compared to what it was the case up until now. That means also there is going to be a significant financial statements effect, particularly in the general insurance, when these large commission paid on the anticipation of future renewals will now no longer go into losses on the first year group of contracts. Instead will be capitalized as pre-coverage cash flow assets and then allocated to future groups as they are issued. There is going to be, of course, more cost for the general insurance companies to implement this, because you will have to implement impairment, allocation basis, disclosure, roll forward tables, and so on and so forth. But overall, the cost is expected to be lower than the benefits that users and preparers of financial statements will get from this amendment. Number 4 is the change in the earning of CSM when you have investment components. You remember there was a first portion of these that came out in the June board meeting last year, and then another one in January this year. The definition of the new concepts of investment-related service and investment return services. Obviously, the complete change in the emergence of profit from both direct PAR and indirect PAR is an important change, is accretive to the usefulness of the information, might disrupt you from implementation processes, but that is supposed to be smaller than the benefits, and that's why the cost-benefit analysis is positive, and the financial statement effect will be material compared to what would be done without these 2 amendments, but this is deemed to be a good change rather than not. Number 5 is the inclusion of insurance contracts as a hedging instrument for the IFRS 17 hedge accounting for VFA. Again, not much to say here. There is a good analysis here on the slide that says usefulness remains good, given that this is another instrument that will now be treated in the same way as derivatives as far as the hedge accounting is concerned. Not disruption present on ongoing implementation. Obviously, impact on financial statements for sure, but that's a good thing, and as a result of all these, cost-benefit analysis again should be passed. The next one is another important amendment. This is on reinsurance held, where the credit you get from reinsurance for onerous contracts at initial recognition now is going to be clarified to be a mandatory requirement. That would eliminate a perception of potential material accounting mismatch. And so when you look through the analysis, there is going to be a better information, more useful, because of this closer and more faithful reflection of the economics in the financial statements. That could disrupt implementation, but again, it should be absorbed by the fact that there is positive stakeholder feedback about this change. The financial statements impact is material, but is a good material impact, and therefore the cost-benefit analysis is again a positive, despite the cost of implementing a different treatment for insurance contracts. Number 7 is a balance sheet simplification. That's when the IASB decided, only instance so far, to change the level of aggregation. For presentation in the balance sheet, we will use portfolios instead of group of insurance contracts. There is a bit of a destruction of useful information because more netting will take place, but that's on balance acceptable, says the IASB. No expectation of unduly disruption of ongoing implementation activities. Of course, there is going to be a smaller balance in terms of assets and liabilities on the balance sheet, but then in terms of the cost and benefit, this should be still a positive outcome for users, and the IASB approved that one too. Number 8 is a deferral of 17 by 1 year. Again, they rehearsed the same arguments and concluded that they will stick to the 1 year deferral. I know that the industry continues to be vocal to ask for an extra 12 months deferral, but at the moment it doesn't seem to be on the cards to be granted. Equally confirmed is the deferral of the IFRS 9 mandatory application to entities with significant insurance operations, which will remain aligned to the 1st of January 2022 new proposed effective date for IFRS 17, with similar considerations as to the cost benefits and impact on usefulness of information and ongoing implementation processes. Number 10 is a specific general insurance improvement of the modified retrospective approach, where general insurance will be given the opportunity to avoid the creation of CSM on past acquisitions of liability for incurred claims. Effectively, you're going to book that difference between the fair value and the fulfillment cash flows through retained earnings instead of creating a CSM and turning those liabilities into liability for remaining coverage. That, of course, creates inconsistency, creates differences in terms of the expectation of revenue, but overall, based on the feedback received and the fact that insurance companies in the general insurance sector will save money, the board was happy to proceed on this amendment. Another transition, but this one more for the life insurance sector, is on the date of application of the risk mitigation. They allowed us to move back to the transition date, so effectively to restate also the comparative period. Again, positive in terms of usefulness, given that the comparative period now becomes comparable with the current period, and effectively no impact in terms of disruption or cost, given that you got to do this anyway. Obviously, financial statements affect material because the comparative period will be very different as a result of that, but that seems to be a good thing. And similarly, the next one, number 12, is the fact that you have now a different transition permitted for the portfolios which are in this hedging relationship. You can apply for value effectively on the 1st of January 2021 to eliminate the opening accounting mismatch that would otherwise exist, given that the derivative accumulated fair value gains and losses in equity will not change, and without reflecting that in the CSM, you potentially end up with a mismatch. Now that CSM will be fair valued, and through the fair value, there is an anticipation that a portion of that CSM will be effectively released to the opening equity, thus mitigating the accounting mismatch. The 13th amendment that the IASB considered is effectively the bucket of all the annual improvements that the IASB staff put together, saying that in their opinion, and the proof of the pudding is in the eating, so we'll see whether it is true, none of these amendments is expected to be significant in terms of financial statements effect and cost benefit. This is hopefully a useful slide that we have done for you. You can download the presentation later on. That shows you where each of these 13 changes have been debated, so you can go back to the IASB website and download any detailed papers once you get the exposure draft, if you want to find out more about each of those, the pros and cons of individual topics. Then the next thing I want to say is that the IASB went through the assessment of the due process steps, and particularly decided again to go through the decision on the effective dates and confirm that they are happy to defer by 12 months both the effective date of 17 and the deferral of IFRS 9. They also confirmed unanimously that all of the decisions reached to date should go ahead in the exposure draft, and as a result of that, they approved for the ballot process to begin in earnest on the 10th of April. In terms of the due process and what it is, that's another slide that we've done for you that effectively captures graphically what the IASB said they've done. It's written in the paper, so we're just presenting it in a more colorful way than the paper, but it is effectively what the IASB has done. As you can see, quite a lot of activity, and then the grey bullets at the bottom half is what is coming next. There will be also some additional documents on top of the exposure draft, like a press release and a snapshot to give a fast briefing to people that want to know within a matter of hours as to what is the content of the new exposure draft and what does it do to them. Then coming to the last part of the board meeting report, the sweep issues, there were 5 of them, as I said in the highlights. Apart from the first one, they were all leading to a decision of doing nothing. The one that results in doing something is obviously the effective date of the proposed amendments will be calibrated on the proposed effective date of IFRS 17. That's a logical step, of course, but it has to be documented. The other 4, actually, the board agreed to do nothing. 2 of them were to introduce a risk mitigation hedge accounting for the general model, or to modify that in the VFA, and they said no. And the number 4 is to actually introduce some further disclosures on net settlement in the roll forward table disclosure. They decided not to do anything about that. And the last one is whether they should change the IFRS 9 transition requirements for when an entity applies 17 and 9 at the same time, effectively to make IFRS 9 restatement compulsory. They decided not to do it. It would be too complicated to touch IFRS 9 on that topic, and so they decided to leave it as it is. So that means that there could be some insurers that may not restate comparatives for IFRS 9 despite restating IFRS 17. All that approved unanimously as the rest. And then the other improvement, we got a few. The first 3 on this page, we got 2 actually which are associated with the unlocking of CSM. These are actually 2 that personally I will rate as quite material. Despite the view of the IASB staff. The change in B96C for the investment component experience variances is quite important because now we got to take that figure and break it down in 2 parts. The one that is from financial risk cannot go to CSM now, it has to be posted in profit and loss, or if you have chosen the OCI option, split between P&L and OCI, and the rest, only the rest goes to CSM unlocking. The staff said that there was an inadvertent omission. They always meant that to be the case, so believe it or not. And then the next one is the one that comes from the TRG discussion on the disaggregation of changes in the risk adjustment for non-financial risk, so that will be amended. And the third one on this page is the clarification that you cannot voluntarily discontinue the IFRS 17 hedge accounting, the risk mitigation approach. You can only suffer the consequences of losing one of the qualifying criteria, and at that point you discontinue. But that happens because the qualifying criteria are no longer met, not because you have decided to stop. And that is to maintain the IFRS 17 hedge accounting in line with the IFRS 9 hedge accounting principles, where no voluntary discontinuation is permitted. The next 3 annual improvements are the first one, clarity on definition of risk component. We already spent quite a lot of time in the webcast, so you will excuse me if I don't elaborate any more on that point. The next one is the amendment to IFRS 17 on investment contracts with DPF. If you are unbundling an investment component that is distinct from an insurance component and it happens to become an investment contract with DPF, would you still account for it under IFRS 9? The answer is no, which is logical. You stick to IFRS 17, and that will be made clear in the text of the amendment. The last one on this page is the amendment to adjust the loss component for changes in the risk adjustment for non-financial risk. The words in 48 and 50 are a little bit unfortunate. You could actually read them that the risk adjustment changes should not be allocated to the loss component, but actually they didn't mean it to exclude them, and so the words will be fixed to avoid this inadvertent error. And then finally, there will be an amendment, which I mentioned earlier, to actually clarify that all the changes in cash flows arising from fair value in the line items will be classified as insurance, finance income and expenses, and no matter whether there is a fair value gain or loss on the other side, that is the only treatment that IFRS 17 will permit. And then finally, going back to some of the annual improvements that were agreed in June, in particular the difference between the changes in fulfillment cash flows when they are measured at current rate and the adjustment to the CSM measured at the locked-in rate, and the fact that if you have chosen the OCI solution at a portfolio level, it could become more onerous to prove that the accumulated OCI balance goes to zero. The staff concluded that they don't want to change these requirements because it will affect the unit of account, and therefore they would advise the board to keep paragraph 22 of IFRS 17 as it is. Again, unanimously approved all of these amendments by the board. And so then coming to the end of the presentation, in terms of next steps, another board meeting scheduled sometime between the 13th and 17th of May to finalize the comment period and other important decision that from a procedural perspective will have to be debated in public. I believe that there is a possibility for a few more STRIP issues to come through. We'll see if investment component accounting comes in or not. But that will be really the final stage. At that point, it will be a private ballot vote and then the publication of the exposure draft sometime in June. The IASB has also told me and the other TRG members that we are not disbanded as a group, but there is not another date in our diary for a fifth TRG meeting for now. That will depend on the submissions that may be received going forward as to whether or not we're going to have our final meeting at some point. So that is the long account of what happened during this month at both TRG and board meeting. And as I land to the last page of the presentation today, I would like to invite the recording to be stopped and to open the floor for any questions.